The next topic that we're going to discuss is equity valuation. So this equity part comes as a part of assets in CFA level 1. Again, a decent weightage of around 10 to 12% at CFA level 1. Now let's discuss what exactly is equity going to cover in CFA level 1. Okay, so what are the asset classes? When we talk about asset classes, so we have a business. Let's say it needs capital, so it can either raise loan or debt for that matter, or it might have equity, right, which is basically, if you in case of Richie's Coffee, the amount of money that he invested was equity, his own money. So your own money, the owner's money, is called equity, owner's contribution. And then we have derivatives. We'll come to derivatives later on the uses of it, but basically derives its value from an original assets. So we'll not get into the details of derivatives as of now. Let's try to just understand that it is used for hedging business risk as of now. For now, let's consider debt and equity. So let's tweak the entire story again. So Abhishek Jain decided to start a business of restaurant. He estimated that a setup cost of 1 crore would be required, and let's say instead of saving 1 crore, he was only able to save 50 lakhs after working for 15 years. Now he still needs that 50 lakhs, right? So there's a 50 lakhs deficit. Now he has two options. Either he can approach a bank or look for a partner. So if he approaches a bank, it's called debt. If he looks for a partner or making him an owner, then it is equity. So raising money. So he approached HDFC Bank, right? And HDFC Bank unfortunately rejected the plan of giving him 50 lakhs for two reasons. One is the high risk of failure, since Abhishek did not have any business background, or he did not have a guarantor. Also, he did not have any collateral. Most of the cases when you approach a bank for a loan, especially home loan, you tend to get the home loan because you have the house as the collateral, right? At the end, when the loan is raised, in case of a home loan, the house papers are kept by the bank, in which case even if you default, the bank could sell this house and get his loan money back, right? So in this case he did not have a collateral, so HDFC Bank basically rejected the offer. So this is gone, right? This is gone. So the other approach is he approached Supreet from his hotel management days, basically his friend, and he decided that he could give him 50% partnership on the business, but Supreet would end up becoming a owner of the business. So the ownership now has split. So it's 50-50%. Right? So this is basically equity. So this sounded like a better option. So raising money through HDFC is debt. Raising money through Supreet is equity. Okay. Now let's see what happened after that. So the business was a huge success. They were able to open 5 branches in Pune, and now they wanted to expand after that all India. So they needed to raise another 300 crores for branches all across India. Now the option is, obviously, when you are trying to raise such kind of money, the option is to take the ownership from Jain and Supreet to the public, right? So common shareholders like you and me could be approached to take ownership in the Richie Coffee's business, right? So you go to the capital markets and create a initial public offering. So that's what is basically called an IPO. So where private business turn into public business. So this is where you were at the beginning. You started off the business, you expanded using loans, right? In our case, we went to the bank, but it was rejected, so we approached Supreet in that case and got another partner. We expanded more, and gave the ownership to the public, and it became a public listed company. So that's what, when we mean public and private company, that is what we mean. In this case here it was private, even here it was private, here it is public. So there are two kinds of equity basically. So let's see, in this case you were expanding, you required partners, so you got in Supreet here, right? And you approached the common people, so they said that they do not require any fixed dividends. So what are dividends? So you remember the income statement that we covered, in which we were left with net income, right? So after net income you have two options: either you keep it in retained earnings, which is basically you keep it in the business, or you give dividends, right, to the owners. So some part of the profit can be given to the owners of the business, which is basically called dividends, right? Either a company might say that they give the entire profit as dividends, or they might say that okay, let's keep 80% as retained earnings and let's distribute 20% as dividends. So in case of common equity, there is no fixed dividends, right? Sometime there might happen that 20% is coming as dividends, sometime there might be nothing. In case of preference shares, let's say in the expansion phase, you approach Supreet fathers as a equity partner, right? Now this is again still the expansion phase. I'm not talking about a public company as of now. And Supreet's father said that okay, I'll give you the equity and I would like to become the partner of the business also, but I require a dividend of 6% fixed, right? So that's basically called the preference shares, because these shares will be given preference in case of dividends. The recent listings which are happened where private companies were taken public are PNB Housing Finance, ICICI Prudential listing happened, Varun Beverages were listed, L&T Infotech was listed, and similarly for RBL and Endurance Technology. So these all companies got listed in NSE, which is the National Stock Exchange, where all the public companies are listed. So once they are listed, they may change hands. So for example, in this case of Richie's Coffee, let's say Jain and Supreet were the owner, right? After that they approached the public. So the public were owners initially during the IPO, and then it might so happen that these people who initially bought the initial public offering stocks might sell it to others, and it will keep changing hands. So the trading will keep on happening, and the stock price might go up or down depending upon the demand and supply, right? Or how much the seller wants to sell it for, or how much the buyer wants to buy it for. Major companies in NSE, public companies which are a part of NSE, are State Bank of India, Axis Bank, Tata Motors, HDFC Bank, Bharti Airtel and Kotak. So these are big companies which have been listed for quite some time now, and they become basically are a major part of NSE. The next subject that we're going to discuss is basically fixed income. Now fixed income is basically the debt market, right? So basically a lot of discussion on bonds is going to happen, and this is one of the major asset classes in the world. Fixed income actually is the largest market in terms of size, and followed by equity. So again, the same discussion that we did. So in this case, if we are not going for equity partners, then we go for debt. This is the same story basically. Now let's see what are the changes in the story. So now you approached the friend Supreet before you approached HDFC, and he has the capital but he asked for a 70% ownership instead of 50. So you basically back out, saying that since you have already run this business for so much time and if you've had success, why should you give 70% ownership? So you back out and you approach HDFC for a business loan, but then again it got rejected because of failure possibility, no collateral as well as no guarantor. So you decide that why can't you just approach public to borrow from them. So in the same way, when we went to public and we said that why don't you take ownership in this business, so we called it a IPO. In the same way, you could also approach public for debt, right? Again, there are regulations in that which we'll not try to get into it, but in simple terms, you basically, those are called bonds. In case you are trying to raise money through public like you and me, then you're basically calling it bond. Now you decide to give them 11% interest and raise in lots of 1000 per head, right? So maybe we are saying that one bond is equal to 1000 rupees. Again, raising loan through HDFC and public is debt, raising money through Supreet is equity, which we have already discussed. Now in case of bonds, why bonds? So you need debt, you can approach a bank. Now bank might not lend you according to your own terms, right? So you approach the public and institutions, you give them fixed interest rates and get a good credit quality check. Credit quality check basically means that you try to certify, right, that you will be able to pay the interest to bond holders, right? So you can go to CRISIL maybe and get a credit rating done. You raise money and pay them annualized interest rate. So that's why you require bonds. So the feature of a bond is, let's say the bond value is 1000 and there is a buyer who buys your bonds. He gets an interest of 10% every year, right? And finally, when the entire bond gets matured, the entire principal repayment of 1000 happens to the bondholder, and the duration of 10 years for this. The bond types, if it is less than a year, then it is called money market instruments. If it is greater than a year, it is called capital market instruments. The bond features, so every bond will have a duration. So for example, even government bonds do come in years of duration of 10 years and interest rate which is there. A zero coupon bond says that there will be no interest, so interest is zero, right? So there is no coupon payments that happens, and only the principal, some value, let's say minus 500, matures into, let's say, 600. So that's what happens with zero coupon bond. In case of step up note, the coupon increases with life. So for example, in the first year maybe the coupon is 5%, in the second year maybe it becomes 5.5. so that's basically called as step up note, and coupon is the interest rate which we already discussed. Moving on to the next topic, which is derivative, which has close to around 6 to 7% weightage on the CFA level 1 exam. We'll try to explain you what exactly is derivatives and options in this chapter, and let's see if you're able to grasp the concept. So for example, in this case, Richie's Coffee is the storyline that we have continued, and let's say he needs 1000 kgs of sugar after 3 months. Now as an owner, I would be concerned that the price of 30 after 3 months should not become 35, in which case I'll have to pay 5 rupees per kg more, right? So in this case I would make a loss of 5000, right? So I don't want to do that. So in that case, what should I do, right? So I basically need a derivative by which I can hedge the price risk, right? So these are primary reasons why derivatives are basically used. Let's see how it happens. So let's consider that instead of 1000 kgs he wants to just buy 100 kgs after 3 months, right? Now he approaches the derivative exchange, right? When he approached the derivative exchange, he saw that the only contract that he can basically avail is 1000 kgs. So he needs to be able to hedge 1000 kgs, not 100 kgs. So in this case, the problem that has happened is the size has mattered here, and hence he will not be able to hedge using a derivative instrument which is available on an exchange. So what he does is approaches another person. So let's say this is Richie, right? Now what exactly he does not want is he does not want a price risk, right? So he does not want a price risk. So what he does is he approaches, let's say this is Richie and this is Mr. X. So he wants to buy at 30 and Mr. X, who is a wholesaler, wants to sell at this rate, right? So both want to basically hedge price risk, because from Mr. X perspective also he's worried that the prices might go to 25. So in that case he will make a loss. So why doesn't he get into an agreement now itself with Richie and say that after 3 months I will buy from you 100 kgs of sugar at the rate of 30, and Mr. X says that okay, I'll sell you that at 30 after 3 months. Now since this contract is between them, the price risk has been hedged, right? Now in this case, since he approached an individual and made a agreement separately, it is called a forward. Now so that's what basically is been written here. So the problem is that you will have to take a pain of finding a counterparty. So in this is like a manual case where you will have to go and find a person on the other side who is able to take a opposite position for you. Also there are issues with credit risk. It might so happen that Mr. X might default, right? He might make the entire agreement void at the end. So this is the problem with forward. So it's a manual agreement, right? Rather he could do is he could approach an exchange, right? So there are a lot of exchange which are available like MCX and CDEX, which give standardized solutions on derivative contracts. So Richie, if let's say he wants to hedge 100 kgs of sugar and a lot of 100 is available, then he can just buy or sell a contract depending upon the requirement. So in this case he will have to buy because he does not want the prices to go up, right? So he'll buy and say that okay, I'll buy at 30. So if this goes to 35, it basically profits him with 5 rupees on each lot. So total profit of plus 500 is made. And when he goes actually to buy, so when he actually, so this is with the contract, okay? So I'll just write as contract. So this is in case of the contract which he's buying here. And in the real scenario, when he actually goes to buy, he'll buy instead of 30, he will buy at 35 in the market. So he will make a loss of 500, right? Because the prices have increased. So in this case, plus 500 minus 500, so it's 0. So price risk has been hedged. So in case when you approach a standard contract using a derivative exchange, it's basically called a future. In this case there is no basically no counterparty risk. The reason being exchange does that for you. So credit risk is basically
eliminated. Now you would also hedge, obviously using a little bit of common sense, since hedging for such a small amount of profit won't make sense, right? Because you're just hedging here rupees 500. Now you would hedge in case, because there will be transaction costs which are associated, right? So mostly you will have to keep in mind the transaction cost and the volume of the transaction before you jump into a future transaction. Now apart from obviously hedging purposes, futures and forwards, majorly futures, are also used for speculations, right? So if I say that today I want to speculate on gold, that the gold prices will go up, so I can go to a derivative exchange and buy a gold contract, right? If I am expecting that the prices are going to go up. If let's say the prices are going to go down, and that is what my speculation says, then I can go and sell a contract, right? So it's also called shorting. Shorting an asset, and this is long an asset. So two terms here. So examples of future contracts. So if you just go to NCDEX website, you will be able to see this contract. So here in this case you are also able to see barley, coriander, cotton, guar, right? So all that contracts are available, and daily prices are given, so percentage changes are also given, right? Okay, now what's option? So let's take this case. So there's Susie who owns this house, right? So she's the owner, and she has put this house for sale for 500,000, right? Just nearby that place there is Peter who would like to buy this land near Susie to develop into a mall. So this is the first case, right? Well, unfortunately Sammy does not have the money to pay till 3 months for 500,000, so he does not want to lose out this deal of buying this house for 500,000. So what can he do? So Susie gives him the right to buy this house after 3 months at 500,000 if he pays her, which is Susie, a premium of 5,000, right, for this right. So Sammy has the right to buy this house after 3 months for 500,000 if he pays her 5,000 rupees now. So it's a right, it's not an obligation, right? Now let's say Peter buys the land and he develops it into a, he wants to develop it into a mall. So since he is trying to make a mall here, the prices go up from 500,000 to 600,000. But you see, Sammy still had the option to buy it from Susie at 500,000, right? So he had paid 5,000 premium to get this right. So he still gets the right to buy this house for 600,000 or 500,000. Now let's see option scenario 2. Let's say Harry buys the house, buys the land and creates it into a dump, right? Now the prices go down. So Sam, what he'll do is, since it is a right and not an obligation, he will leave the option expired. So basically Sam will lose out that 5,000 rupees that he paid, but Susie still gets to keep that money of 5,000. Derivative exchanges in India, MCX is for majorly metals, NCDEX is for agricultural commodities, then you also have National Stock Exchange for currency derivatives, also stock derivatives, and also index derivatives like Nifty and Bank Nifty. Alternative investments. So we discussed equity, which are traditional investments. We also discussed fixed income, right? Now anything apart from these usual investments which are not related to equity and fixed income directly are basically called alternative investments. So for example, Abhishek Jain has his business, which is also you can term as equity. He can also invest in a bond, right? But now he wants something else which is not related to both of them, right? So for example, when the business environment goes down, right, so equity also can go down, as well as bond markets also sometimes can go down. So you need an asset which does not move with equity and bond. So those are basically called as alternatives, right? As the name suggests, it's an alternate assets. So these are the features. Doesn't move with equity and bonds, will provide you diversification. So some part of your money, like around 15% of your assets, should be invested in alternative assets. Can also generate higher returns depending upon which alternative assets you choose. There are also hedge funds which are available, which tend to generate you higher returns, so and also do not move with equity and bonds. And in the overall portfolio basis, so let's say if you have 1 CR and let's say 15 lakhs is kept with an alternative investments and 85 lakhs is kept in traditional. So what happens is the overall risk combined reduces. So the risk overall reduces. So examples of alternative investments in India is real estate, because real estate really does not move with equity and bonds. Gold is inversely correlated with equity markets. So if equity markets go down, gold prices go up, right? Most of the times. Paintings are also one source of alternative investments, and hedge funds are also there. A lot of hedge funds have also come into India, like Ambit, also Forefront. You can check out their websites, and they have some complex trading strategies which are basically zero correlated. So even if the equity markets are going up or going down, what an hedge fund tries to do is it is independent of the direction of the general traditional investments. Now the features: real estate, not easy to sell, so there is liquidity issues here. You may buy real estate, but it is not easy to sell. Again, gold, if you buy in physical form, it is not easy to sell. There will be making charges in this. Again, paintings also is not easy to sell, and probably even not easy to buy. Higher ticket size: if you go ahead and buy a house, it would cost you somewhere around 1 crore. Gold is a flexible ticket size, so you can start somewhere between 10,000 also. Paintings are higher ticket size, because if you're looking for rare paintings, then probably the ticket size may be pretty high. In case of real estate, higher diligence is required. What I mean by diligence is that you need to find out if the product is correct, if the papers are correct. Higher transaction costs are there because there is tax associated with it, there is stamp duty associated with it. So transaction costs are pretty high in case of real estate. Gold, as I already discussed, making charges are there, so which reduces the attractiveness of buying physical gold. Paintings, higher maintenance is there because you will have to keep it at a very maintained state in order to sell it later on. And fake paintings are also a big problem, because you might go up and buy thinking that it's a original painting, but it might turn out that it might be a fake. So that's a risk that is there. A real estate index which is available in the Indian markets. It is given by NHB. So it basically gives you an index as to how the prices have been moving year on year. So for example, in 2007 the index was at 100, and by 2011 it has come to 83 in case of Hyderabad. You can also take the Mumbai's case. So from 100 rupees it has gone into 175. Now this does not mean that we are giving any per square feet rate. It's just an index trying to say that this is how the prices have moved. So if you had invested 100 rupees, today it would have become 175 rupees. So why alternative investments? Structure of investment vehicles and the type of assets securities included in the are different from traditional investments. Now the features, basically we have already discussed. Less liquidity. Now this needs to be handled by more specialized investment managers. There is less regulation and transparency, and that's the reason why alternative assets is not available for most of the investors. It's more problematic because the hedge fund, or even for that matter most of the alternative investments, will lack data availability, which makes it very difficult to analyze it, and different legal issues and tax treatments in different countries. So for example, if you are in Mauritius, then the regulation is next to zero. If you are in India, it is over-regulated. Again, the tax problems are there. In case of Mauritius, it's a tax haven. In India, there's no such exemptions.